Most investors think a market crash begins on a screen. They think it begins when the SP drops fast enough to scare the television anchors, when the red numbers get large enough to feel real, when somebody on the internet finally says the word panic with the right amount of theater. That is not when a crash begins. A real crash begins earlier, in a place most people never look. It begins when the cost of energy stops being a line item and becomes a tax collector, moving from balance sheet to balance sheet, from tanker to refinery, from refinery to freight, from freight to factory, from factory to store shelf, and from store shelf straight into the psychology of every central banker, lender, business owner, and household in the country. By the time the stock market reacts, the mechanism is already running. And if you do not understand that mechanism, you will do what most people always do. You will mistake noise for danger, danger for opportunity, and opportunity for permission to behave recklessly. I have spent a lifetime around markets, management teams, insurance contracts, recessions, bubbles, and all the little stories human beings tell themselves when money gets emotional. What I can tell you is simple. War does not make some investors rich because they are courageous. War makes some investors rich because it reveals with unusual cruelty who built a portfolio for applause and who built one for pressure. Those are very different things. A portfolio built for applause looks brilliant and easy money. It is concentrated in whatever the crowd has decided deserves a premium. It borrows confidence from recent returns. It confuses momentum with quality. It treats rising prices as proof of intelligence. It usually carries hidden leverage. If not on paper, then in psychology, the owner thinks he can tolerate volatility because he has only experienced volatility while liquidity was abundant. And every dip eventually became a bragging point. A portfolio built for pressure looks almost boring until the room catches fire. That portfolio is designed around a harsher question. Not how rich can this make me if everything keeps working, but how intact can I stay if several important things stop working at the same time? That is the question 2026 is asking. A lot of people still think this is a normal pullback. They see expensive growth stocks sliding, popular names cracking, software leaders retracing, safe havens acting strangely, and they tell themselves this is just a sentiment tantrum. They want it to be simple because simple markets let you keep your identity intact. They let you keep saying you are a long-term investor while secretly behaving like a tourist. But this environment is not simple. This is what happens when a geopolitical shock collides with a market that had already priced in easier money, cleaner inflation, lower rates, and a future that was far more cooperative than the real world had any obligation to be. That fantasy is being repriced. Now, the first thing I want you to understand is that an oil shock is not an energy story. It is a system story. People hear oil and think gasoline. That is amateur thinking. Oil is transport. Oil is fertilizer. Oil is plastics. Oil is packaging. Oil is aviation. Oil is trucking. Oil is industrial heat. Oil is margin pressure. Oil is consumer stress. Oil is slower hiring. Oil is lower confidence. Oil is 1,000 invisible invoices arriving at once. If the price of energy rises hard enough and stays there long enough, it does not just make one sector uncomfortable, it rewrites the profit assumptions of the whole economy. That is mechanism one in my mind. I call it the energy tax. The energy tax is merciless because it arrives before the accounting culture can rationalize it. It raises the cost of moving goods before management teams can fully reprice them. It narrows margins before analysts cut estimates. It hits the family budget before consumers admit they are changing behavior. It turns the market from a popularity contest into a quality audit. And when that happens, valuation stops being a flattering story and becomes a survival variable. That is why the first stage of a serious repricing always feels unfair to people who are living off narratives. They keep saying the business is still great. Maybe it is. But a great business bought at an arrogant price is not safety. It is just delayed disappointment. For years, I have watched investors use the word quality when what they really meant was size, familiarity, or recent stock performance. They saw giant technology companies trading at valuations that assumed years of perfect execution, low rates, clean demand, and endless enthusiasm. Then they told themselves that because the businesses were real, any price was acceptable. That is not investing. That is surrendering your judgment to the crowd at a premium. When money was loose, that surrender looked brilliant. When energy, inflation, and rate expectations turn against you at once, it looks like what it always was, a concentration risk dressed in expensive language. Now the second mechanism begins, I call it the rate trap. The rate trap is what happens when inflation pressure returns at exactly the moment the market was depending on easier policy. Investors had spent months, in some cases years, building portfolios around the idea that central banks would eventually rescue duration, rescue growth multiples, rescue speculation, rescue leverage, rescue all the things that become fragile when money is expensive. That rescue becomes much harder when an oil shock is doing the inflationary heavy lifting. If prices are sticky and energy is feeding the stickiness, a central bank cannot behave like a generous uncle without damaging its own credibility. It becomes trapped between two embarrassments. If it holds rates high, it tightens into weakness. If it cuts too early, it looks frightened and risks reigniting the very inflation it spent years pretending it could control. Markets hate that kind of trapped authority. They can tolerate bad news. They can tolerate recessions. They can even tolerate war for a while. What they cannot tolerate is discovering that the adult in the room has fewer clean options than advertised. That is when another repricing starts. Investors begin to understand that policy is no longer a clean tailwind. It is a constrained variable, a forced variable, a political variable. And once the market starts thinking that way, the premium it is willing to pay for long-dated promises shrinks. That hurts the most crowded parts of the market first. The people who get hit hardest are not necessarily the least intelligent. Usually they are the most overcommitted. They own businesses whose future cash flows live far out in time. They need confidence, liquidity, rate relief, and emotional stability to keep those valuations standing. Remove enough of those pillars at once, and the multiple does the violence before the income statement even gets the chance. Then comes mechanism 3, I call it the dollar magnet. When the world gets stressed, money does not always run where the textbooks tell you it should. It runs where obligations are due, where yields are available, where liquidity is deepest, where collateral is accepted, where fear can hide inside something that still looks official. That is why investors get confused in times like this. They expect the old script war begins, gold rises, stocks fall, bonds rally, and everyone feels clever for memorizing the pattern. But a pressure event can scramble the order. If higher rates or higher real yields suddenly become available, if the market starts grabbing for dollars, if funding stress makes liquid paper more attractive than inert conviction, then the supposed safe assets can get sold too. Not because their long-term case has died, but because in the short term the system is demanding something else. That distinction matters. One of the great mistakes investors make is assuming that price action and strategic truth must move together. They do not. Sometimes an asset falls because its thesis is broken. Sometimes an asset falls because somebody somewhere with more leverage than patience has to meet a margin call. If you cannot tell the difference, you will sell what you should study and buy what you should distrust. I have seen this confusion all my life. People think they own protection, but what they really own is a structure that behaves like protection, only when the path is smooth. The moment the dollar strengthens, rates rise, algorithms fire, and leverage products are forced to rebalance. That structure stops acting like insurance and starts acting like an accelerant. That is why I dislike leverage for most people. Leverage is sold as speed. In practice, it is often fragility with excellent marketing. A man buys a leveraged precious metals product because he thinks he is expressing a long-term view on monetary disorder. What he is really buying is a machine that has to react to short-term price movement, whether he likes it or not. If the asset falls, the machine must adjust. If the machine must adjust, it sells. If enough machines sell together, the decline becomes self-feeding. Then the man who thought he owned a decade-long thesis is wiped out by a weekly move. He did not lose, because his macro idea was impossible. He lost because his vehicle could not survive the road. That is mechanism 4, I call it the forced seller spiral. The forced seller spiral has ruined more promising investors than bad analysis ever will. It begins with a true observation, then adds impatience, then leverage, then a need for the market to validate the thesis on a schedule. Once that schedule breaks, the investor becomes a servant, not an owner. He is no longer choosing. He is responding. And responding is expensive when everybody is responding to the same thing. This is why I say again and again that survival is not a defensive concept. Survival is the base rate of compounding. You cannot earn from the recovery if you are carried out during the liquidation. Now, because people hate ambiguity, they immediately ask the wrong question. They ask, what should I buy right now? That is not the first question. The first question is, what kind of portfolio do I currently own? Do I own a real portfolio? one that can stay rational under stress, or do I own an identity made of ticker symbols? Do I own businesses with balance sheet strength, pricing power, durable demand, and cash generation? Or do I own stories that require lower rates, brighter moods, and greater fools? If you answer that honestly, half the work is done. There are businesses that become more attractive in this sort of environment, and I am not speaking only about oil or obvious war trades. I am talking about companies that do not need the capital markets to stay open every morning in order to remain alive. Companies with cash instead of excuses. Companies that can pass through costs because their products or services are still required in a harder world. Companies that can endure weaker spending without discovering too late that the last 2 years of prosperity had hidden a very mediocre operating model. When the environment gets harsher, I get less interested in what management says and more interested in what the balance sheet says. Cash matters. Debt maturity matters. Interest burden matters. Free cash flow matters. Pricing power matters. Dependency on hope matters. If a company has a fortress balance sheet and abundant cash, it enters a slowdown with optionality. It can keep investing while weaker rivals shrink. It can repurchase stock when the market gets stupid. It can survive a credit squeeze without pleading for mercy. It can turn a bad environment into an acquisition environment. That is what quality looks like when the room is hot, not a slogan. A position of strength. This is where most investors start feeling embarrassed because they realize they were not diversified, they were merely multiplied, they own different names, but all those names were expressions of the same macro assumption. Easier rates, endless demand, forgiving liquidity, premium multiples. If that assumption breaks, the portfolio does not offer variety. It offers synchronized pain that realization is healthy. A lot of people think diversification is boring because they encountered it first in textbooks. They think concentration is what serious investors do. Sometimes it is, but serious concentration comes after deep understanding and with a deep tolerance for drawdowns. What most people call concentration is just emotional overexposure to the part of the market that recently made them feel intelligent. There's nothing sophisticated about that as I see it. This environment separates 4 species of investor. The first species is the tourist. He arrived during the easy phase, mistook a rising market for a personal trait, and will probably sell because his self-image cannot tolerate a market that refuses to cooperate. The second is the collector of stories. He will keep explaining why all his companies are wonderful, as if wonder were a valuation discipline. He may survive, but he will be taught the hard lesson that great businesses and great entry prices are not the same thing. The third is the forced seller. He has the right instinct, but the wrong structure. Too much leverage, too little cash, too much dependence on the next pay cycle, the next rate cut, the next bounce. He will be correct too early, then ruined. The fourth is the allocator. That is the only species I care to be. The allocator does not ask how to look brave. He asks how to keep options. He does not try to win the first week of the crisis. He tries to own enough liquidity, quality, and emotional control that the second and third stages belong to him. That is the identity flip most people need. Stop thinking of yourself as someone who must always have the hottest answer. Start thinking of yourself as the manager of a private insurance company whose job is to remain solvent when other people are under stress. The market will reward that shift more than any prediction. Now, let me tell you how I would think if I were laying out a real operating system for this kind of environment. I would begin with runway. Runway is boring until it becomes everything. Runway means enough liquidity that I do not have to liquidate great assets because the world turned dramatic for a quarter or two. It means my life is not one market downdraft away from dictating my investment behavior. It means I can watch panic without being conscripted by it. Most people have opinions before they have runway. That is backwards. Your first protocol is not a stock pick. It is the removal of circumstances that force you to become a weak hand. After runway comes triage. Triage means telling the truth about each position, which holdings deserve to be core because the business can emerge stronger, which holdings are merely acceptable if the world stays kind, which holdings were purchased for narrative excitement and would be the first casualties of a tighter regime when people refuse to do triage. The market eventually performs it for them. That version is much more painful after triage comes staging. I do not like investors who spend all their courage at one price. That is ego disguised as decisiveness. In an unstable environment, humility is practical. If I want exposure to something excellent, I would rather stage that exposure. I would prefer to buy in layers while the market is still discovering what hurts and what heals. I do not need to catch the exact bottom. I need to avoid doing something foolish before the bottom is visible. After staging comes asymmetry. This is where the real work begins. In a panic, I look for places where fear is probably overcharging for uncertainty. Not every beaten down sector qualifies. Some things are down because they deserve to be down. Some businesses are not cyclical bargains. They are structural disappointments wearing temporary discounts. But some areas of the market do become indiscriminately punished. That can happen in software when cash-rich. Mission-critical businesses get sold alongside speculative nonsense. It can happen in consumer finance when the market prices permanent damage into businesses whose economics will improve dramatically if policy or credit conditions stop worsening. It can happen in select consumer companies when the market extrapolates fear so far that it forgets how quickly sentiment changes once households stop expecting disaster every morning. It can happen in international markets and in hard assets when the dollar has had its panic run and policymakers finally reach for the emergency drawer. That brings me to mechanism 5. I call it policy panic. Policy panic arrives when the people in charge discover that confidence is falling faster than they can narrate it away. Suddenly the language changes. Officials who spent months sounding stern become inventive. A war needs de-escalation. A tariff needs reinterpretation. Liquidity needs support. Bond markets need help. Rate paths need flexibility. All the things that were said with certainty become negotiable. This is not cynicism. It is how the system behaves. The market usually bottoms, not when the news is good, but when the response function becomes clearer than the fear function. That is when the allocator gets paid, but you cannot exploit policy panic if you spent phase 1 trying to look heroic on social media. You need capital, you need structure, you need enough self-respect to underreact, while everyone else is auditioning for the role of victim or prophet. I have no interest in being either. I am not trying to be the first person to declare that the worst is over. That game is for television. I am trying to be ready for the moment when the market stops rewarding purity and starts rewarding preparedness. There is an enormous difference during a serious repricing. The crowd always becomes obsessed with headlines. Which missile landed where? Which official hinted at what? Which host used the most dramatic adjective? None of that is your edge. Your edge, if you can call it that, lies in watching the variables that actually transfer stress through the system. Watch the cost of energy, watch funding conditions, watch the dollar, watch real yields, watch whether strong companies are being sold on emotion or on actual impairment. Watch whether policymakers are still pretending or already adapting. Watch money flows, not theater. That last sentence matters because investors love explanations that allow them to keep their habits. They want to believe they are just one insight away from certainty. In reality, markets are usually won by people with habits sturdy enough to function under uncertainty. You do not need omniscience. You need protocol. That is why I distrust investors who speak only in conclusions. Buy this, sell that, rotate here, hide there. I would rather understand the machine when oil spikes and stays high. The machine imposes a tax on growth and a burden on central banks. When central banks are trapped, long-duration assets lose their halo. When the dollar attracts fear and yield, gold and other supposed hedges can get sold for the wrong reasons. When leverage meets falling prices, the system manufactures forced sellers. When forced sellers dominate, excellent assets can become incorrectly priced. When policy panic begins, the assets that were unfairly crushed usually stop going down before the headlines sound safe. That is the machine. Once you see it, the environment becomes less emotional. Not because it stops being dangerous, but because you stop treating danger as surprise. And that is where wealth gets built, not in comfort, in comprehension. Let me say something that may offend some people. Most investors do not fail because markets are impossible. They fail because they ask the market to protect their ego. They want every position to work quickly enough to confirm they are smart. They want every dip to bounce fast enough to preserve their self-image as calm, rational, long-term owners. They want every crisis to follow the script they memorized in an easier decade. The market does not care. If oil reprices the system, if policy gets trapped, if rates stay higher than expected, if dollars get scarce, if algorithms and leverage force the wrong kind of selling, the market will gladly expose all the places where your confidence exceeded your preparation. That is not cruelty. That is disclosure. So if I were speaking to a younger version of myself, or to any investor who is trying to think like an owner rather than a spectator, I would say this: do not ask whether this is the bottom. Ask whether your current structure would let you benefit if the bottom formed 3 months from now instead of tomorrow. Do not ask whether gold, software, consumer finance, or international stocks are dead or alive. Ask which of them are being liquidated because the thesis is broken and which of them are being liquidated because somebody else cannot hold their own financing together. Do not ask how to get rich from the war. Ask how not to become one more casualty of volatility, leverage, and emotional urgency while the true opportunity is still being assembled. And above all, do not confuse activity with control. You do not get paid for feeling busy. You get paid for behaving correctly while other people behave predictably. That is a much rarer skill I have seen investors waste years because they kept trying to win the drama instead of the outcome. They would buy a headline, sell a scare, average down something they never understood, or rotate into the last thing that had just embarrassed them. They thought they were adapting. In truth, they were just being led by the nose through a maze built by urgency. The market loves urgent people. It extracts tuition from them. The calmer investor, the one with cash patience and a real decision framework, often looks slower in the first act. Then the environment starts paying him for his restraint. He buys better assets at better prices. He does it without begging the market to absolve him immediately. He can hold because his life does not force him to negotiate with every red candle. And when the bounce comes, as it eventually does in some form, he owns recovery rather than regret. That is what people misunderstand about Buffett-style thinking. They think it is about liking value. It is really about structuring your life and your portfolio so that fear becomes useful information instead of a command. If the world hands me a market where strong balance sheets get lumped together with weak ones, where dollars and rates create temporary distortions, where panic punishes quality alongside speculation, I do not need to be cheerful. I need to be solvent, selective, and patient. That is enough. Now, let me make this even plainer. If you are overleveraged, the first victory is to stop pretending that courage can substitute for structure. If you are concentrated in expensive dreams, the first victory is to stop calling them inevitabilities. If you are dependent on a fast policy rescue, the first victory is to admit that macro mercy is not a durable investment plan. If you have runway, quality, and discipline, the first victory is simply not to join the stampede. So many fortunes are preserved by not doing the stupid thing on the stupid day. That sounds small until you see what compounds from it, because the next phase usually does come. At some point, the market recognizes that not every business is broken. At some point, policymakers become more active than proud. At some point, the dollar loses some of its panic bid. At some point, rates or expectations turn. At some point, the names that were thrown out together begin to separate. The strong recover first. The merely fashionable do not always come back. That is where real discrimination pays. But that phase belongs only to people who did not self-destruct in the opening act. That is why I keep returning to the same idea. This is not a stock-picking test. It is a pressure test. And the pressure test is revealing whether you built wealth on optionality or on adrenaline. I know which side I want to be on. I want the side that can sit still when stillness is the hard thing. I want the side that can buy carefully when everybody else is desperate for certainty. I want the side that treats cash as future courage, not dead money. I want the side that knows a cheaper price is not automatically a bargain, but sometimes it is the market offering dignity to the patient. And I want the side that remembers this final truth. The market never really asks whether you are optimistic. It asks whether you are prepared. That is the mirror. When the screens are red, when commentators are theatrical, when safe havens are acting strangely, when every position feels guilty by association, when oil is whispering recession and rates are handcuffing policy, you will be tempted to do something dramatic so you can feel in control. Do not make that decision in the image of your frightened self. Make it in the image of the future self you are still responsible for protecting. Write that contract now before the next violent week arrives. Tell yourself that you will not use leverage to compensate for impatience. Tell yourself that you will keep runway so you are never forced to sell excellence to finance anxiety. Tell yourself that you will audit valuation with as much seriousness as business quality. Tell yourself that you will stage entries instead of worshiping precision. Tell yourself that you will follow the machine, not the circus. Tell yourself that you are building a fortune that must be able to survive phase 1 in order to deserve phase 3. That is the real test, not whether you can predict the next headline, whether you can remain the kind of investor who is still standing when the headlines stop mattering.